Well, I think the most important thing is we are, at MasterCard are all about getting rid of cash. Our whole focus is a world without cash, a digital world which we know leads to financial inclusion everywhere. And so one of the biggest challenges is obviously getting that acceptance of that digital cash, right? And there, it seems like an oxymoron, but it really is a digital way of accepting payments. And thus, moving the world that way actually will increase economic growth everywhere. And that's what our biggest focus is on. The challenge is obviously working with different governments, with different players in that, whether it be merchants, whether it be banks and issuers, and how do we all get an ecosystem together which benefits everyone, but actually also keeps things safe and secure for consumers as well. And that's really been the biggest challenge, and it will continue to be the biggest challenge, but also the biggest opportunity as well.
Biggest challenges over the past several years has been, I think it's interesting, the market is still somewhat, for several years now, has believed that we are near the end of the cycle, that real estate is priced to perfection, cap rates at all-time lows, how much lower can they go? Are we in a bubble? And trying to refute those claims, everybody's been expecting interest rates to rise, and they haven't. Certainly in the past 30 days, we've seen it in the U.S., but we haven't seen it elsewhere in the country. And I think people are finally realizing that no matter the interest rate environment, and probably because of the low growth environment, real estate continues to attract capital. In fact, new term I've heard just this morning now twice is TINA. There is no alternative for capital, except for real estate right now. And so the capital flows to real estate remain positive. Yet for several years now, people keep expecting the other shoe to drop and the market to move past a peak.
There's been so much increased regulation on our industry that it's a challenge to actually create all the infrastructure that's required to comply with the regulation and the reporting that the government has imposed on us. And it's also made it very expensive to run our business, where it wasn't as expensive before. So that's challenge number one. I would say the second challenge is actually, in this environment where there's rich valuations, it's being disciplined and staying disciplined and finding interesting opportunities and communicating that to our investors. I think we can continue to find those opportunities, but it's a matter of also communicating to our investors that these are attractive and have that match the demands of their boards.
One of the big challenges that I think all investment managers in property have faced is really getting access to good product at reasonable prices, and doing so in a way that helps build a portfolio that does what it's intended to do. The challenge there has been that deal flow comes at you in a very sporadic way. You have to react. The challenge is to, as I say, is to do your portfolio homework first, so you know the opportunity when it comes across your desk and you're able to react. The challenge, I think, going forward is that even if you do your homework, I think the deals that you have to react to are going to be very, very expensive. They'll be very fully priced. We're at a very different pricing level than we were 5 years ago. And so what you're going to need to do is have the courage of your convictions to pay top dollar for very expensive real estate, or be patient and wait. Those are your two choices. There's a lot of money chasing real estate. Real estate's allocations are generally moving up. As we heard at the global property market discussions earlier, there will be probably more money allocated to real estate because we've done so well. And yet the pricing in real estate is up 30 and 40, in some cases 50% over where it was 4 or 5 years ago. So pricing is the biggest challenge. Winning a bid, you want to avoid what we call the winner's curse, which is really a situation where, good news, you won the bid. Bad news, you just paid an arm and a leg for it. So that risk and return balance is still going to be, I think, the number one issue that investment managers face. What I like to advise our own investment committee is be patient, Don't feel like you always need to be the winning bid. Be content with coming in number 2 or number 3. When there's a shock to the system, these sort of structural shifts that are hitting us, you may find that the number 1 and the number 2 bid fall away, and you'll be actually coming in at a price point that you're happy with. And you may need to do that 5 or 6 times to hit one, but that's a better way to play the market in 2017 than simply winning every bid, which I think would be a recipe for poor performance.
Interesting. I mean, it's been a very challenging environment, some of the geopolitical issues that we've talked about, but maybe if I leave the geopolitics and political uncertainties behind, I'd say one of the biggest challenges as a pension plan is having to have our capital invested. We don't have an option of being invested in cash. The returns are too low. You know, we have a liability that we need to meet for our pensioners, and so you have to be able to source opportunities. And in an environment that is very competitive, where returns are compressed and the outlook is uncertain, continuing to find those opportunities and to generate returns in order to be able to pay pensions is an enormous challenge, but something that we're very, very focused on doing.